Hello and welcome to our September quarterly market update. I'm happy to be joined today with Ruby and Hugo, and today we're going to be delving into the key factors that are driving markets and economies at the moment, whilst also delving into some of the findings from our report. It's been a fascinating quarter. We've had a lot of sort of things to digest. Obviously prior to the quarter we had President Trump's Liberation Day on April 2nd, which threw the markets into chaos. And since then, that's sort of been a pattern, this sort of very quickly moving news cycle where something shocks us and then very quickly it's forgotten about and then the next thing comes out. Indeed, we didn't even have a September effect this year. September is normally one of the weakest months of the year, as well as August here in Australia. And indeed, Australia had its best August for over 10 years. The S&P 500 in the US had its best September in over 15 years. So despite all of these things, markets seem to be moving along pretty nicely. So Ruby, tell us more about markets over the quarter. What happened?
Global equity markets performed in positive territory over the quarter that ended September. Some of the events that led to this is the continuing rate cutting cycle, particularly from the US. The other contributing factor is the easing of trade tensions, particularly the US and China being in a trade truce up until November. Also contributing is earnings season that we saw from the US and Australia, showing that broadly speaking, companies are proving to be quite resilient in the face of increasing uncertainty and increasing reversal of globalization. And their earnings are coming through and supporting some of the valuations that they're trading at. Technology-heavy indices, particularly in Australia and China, are really benefiting from the AI thematic, and we saw that these two indices particularly generated quite significant returns over the period in the order of about 11%. It's also worth noting that gold reached another record high throughout the period, and the US dollar continues to weaken against the backdrop of other tradable currencies. What is causing this is the continued geopolitical risks and mitigating against that. Inflation continues to still be of a concern, and just the sheer weight of the size of the US government debt.
You touched on the trade truce, but Hugo, we know that whilst China and the US are currently in truce, at least for another month or so from a trade point of view, tariffs haven't gone away. What's the picture there?
They haven't gone away. In fact, they've actually increased. We went from a period of 2 to 3% effective tariff rates on US imports at the beginning of the year, and now we're sitting around 17.5%. But as you touched on, Ruby, the markets have really looked past that and have, moved really from bottom left to top right and had some really extraordinary results in equity markets. But it's because markets and investors really don't like uncertainty. And for a long time there, we had a lot of uncertainty around what the tariff rate and regime would look like between the US and other nations. And at the end of August, we got some certainty around the US and China, US and Europe and other major trading regions. And markets, despite there being some uncertainty in early 2026 with the Supreme Court ruling whether Trump has correctly used his powers to enact these tariffs, which could potentially mean they're reversed. And a lot of that revenue that's been collected would actually have to be refunded to those nations. But despite that, markets are looking on to the next thing in the moment, and that's really the AI thematic that's driving markets. So, nothing to see here, apparently. So.
Yeah. But of course, nothing to see here. We do at least at the time of filming have the US government in shutdown. So what does that actually mean? Why are they in shutdown, and what does that impact, Ruby?
So the US has been shut since the 1st of October, and it is as a result of the US Congress not being able to pass a bill around their funding, essentially. And it's largely to do with healthcare and budgetary priorities. So when we look back in time, which is a way that we can sort of see how this may play out. So since the 1970s, there have been 22 shutdowns in the US, and on average, they've lasted around 8 days. So we can't crystal ball how long this may last. So who knows? Only time will tell. Looking at it from an investor's point of view, these types of events are seen like any other geopolitical event where markets tend to look through it, see it as noise as opposed to fundamental signaling. However, having said that, the effect that it may have on views and how people allocate money, US Treasuries may continue to lose shine with the broader investor cohort. The US dollar may continue to slip against the basket of currencies, and gold may continue to be considered a more safe haven for investor money.
Yeah, I mean, look, I think that, the US is, in their approach to dealing with allies and foes alike, has definitely lost a bit of the shine, a bit of the credibility, a bit of the status that it used to have. But certainly one of the bright spots and a place that the US is leading is in AI. So, a lot of things to talk about there, but, what did you notice?
Yeah, well, we know that AI is completely transformational. It's changing the way that we conduct our day-to-day lives. It's changing the way we conduct business, and with more shareholder interest in broadly companies and how they are adapting and incorporating AI into their practices. However, from a professional, conservative manager of other people's money, we are very mindful of what this might mean in terms of risks and concerns. So we think that there are probably a number, but there are three that sort of come to mind for me. The first one is on the valuations. So they are seeming very stretched, and with a lot of capital expenditure going into these big tech names, what we want to see is that future earnings are coming through and supporting the valuations. Next is around just the sheer concentration of the major players. So if we look at the US market, the S&P 500, over 30% of that market is held in the Magnificent Seven names. So if you are passively following the US market, be mindful that a lot of your performance may be tied to the perfect performance of these 7 large organizations. And then finally, we are seeing this emerging dynamic around a circular funding ecosystem. So if I can give an example, NVIDIA is committing $100 million to OpenAI for their data centers, which is going to be stocked with NVIDIA chips. OpenAI is purchasing cloud computing from Oracle, who in turn is buying NVIDIA chips. So the concern is that these companies may be providing that support for each other's share price and their own, and we feel that investors should be aware of some of the risks that may happen if there's a chink in the chain, and there might be flow-on effects with one business not sort of being having a perfect outcome.
You make a really good point around the circular nature of the AI ecosystem, and I guess at the moment, investors are betting that 1 + 1 with these companies equals 3 or even higher. So remains to be seen. Maybe they can grow into those valuations and they'll have the earnings growth to support those valuations. But it's certainly something to watch closely. And talking about the concentration as well, investors should be aware that it's not just in equity markets that they're concentrated and have a huge exposure to the AI sector, but it's in private equity, private credit, real estate as well, with data centers and infrastructure plays. So a lot is riding on this AI thematic panning out as investors hope.
And of course, one of the things that immediately comes to mind with the emergence of AI is the potential to impact employment. We've certainly seen, youth unemployment or younger people finding it harder to get jobs straight out of university. But Hugo, I mean, the labour market has been something that seems to have been holding things steady for the last couple of years. Is that still the case?
Yeah, you touched on a really good point. US unemployment under the age of 25, I believe, has ticked up to 11%. So it is quite worrying. But when you look at the headline level, unemployment in August was at 4.3% over in the US. But there was some news that came out throughout the quarter. So we had a pretty weak non-farm payrolls number that was released, which showed that job growth has been quite slow, and quite tempered the last couple of months, and there was quite some big revisions as well in the previous numbers. So certainly the US Federal Reserve is concerned about the labour market at the moment over in the US, and that's why they cut twice throughout the quarter. And it's something they'll be watching closely. There isn't red flags at the moment, but certainly we are witnessing a bit of a weakening of the US labour market at the moment. Australia, luckily enough, our employment market is looking quite robust at the moment. So unemployment is sitting around 4.2%, and it's actually giving the RBA more reason to stay on hold or believe that they're closer to the end of their rate cutting cycle. And so we may see one more cut in the rest of this rate cutting cycle. But if the employment and labour market remains strong in Australia, then that puts pressure on wage price inflation, which was at 3.6% at the last reading. So it's hard to see inflation coming down rapidly towards their 2.5 midpoint range if employment remains so tight.
We've certainly seen over the last month or so a swing from the market expecting definitely 2 cuts by Feb to 1, maybe none. So it's important. But Ruby, obviously this plays a part in income generation within portfolios. So how should people be thinking about that?
Yeah, so what we saw is that from the beginning of the year, in Australia, rates have gone from 4.35% to 3.6%. And investors whose income or whose return is closely tied to the path of interest rates, they're absolutely seeing a reduction in those rates that they're receiving in their pocket. How we guide conversations with the people that we assist is that we say, if your appetite allows you, consider a wider range of investment opportunities from which you can derive an income. So I'm thinking about things like incorporating share investing and therefore deriving an income through the dividends that have that additional benefit in terms of tax through the franking system. And if your sort of mandate or risk appetite doesn't really allow that, then another option might be to look vertically and say, what other opportunities within that category or within that asset class may suit you? So it could be around corporate borrowing or private credit, for example. But of course, none of this is possible if your appetite doesn't really allow that to happen. And you need to be aware that the higher up you go away from cash, away from term deposits, you need to be comfortable that you are increasing the level of risk and therefore a risk of your capital as part of that.
Yeah, it's always really key thing of that trade-off between risk and return and getting that right for your circumstances. Hugo, one of the other shocking things that I guess has happened in the last few weeks is President Trump's speech at the UN, which was interesting and shocking for all sorts of reasons. But one of the things that was quite stark was his comments that climate change is a con job. And so obviously, particularly here in Australia, we're quite close to the environment. What does this mean? Does this mean that ESG, responsible investing, renewables are going away? What do those comments say to you?
Not at all, and it was quite shocking. Not much shocks me from that man at the moment, but that was quite shocking to see him do that at the UN General Assembly. But certainly not going away, in our opinion. The world needs more energy, particularly with the talk of AI and all the data centres and how energy intensive they are to run. So certainly we see it as a long-term thematic, and whilst there's maybe some short-term headwinds they're facing from headlines out of the US, structurally over the long term, we see a lot of optimism and reasons to invest in this space, particularly with rates coming down. So during 2021 to 2024, renewables didn't do that well as an investment, partly because of their high duration nature and interest rate increases negatively impact their performance. But with central banks now cutting, that should also be another added boost to renewable energy as an investment and that thesis.
Yeah, excellent. Well, I could talk to you both all day, but we don't have that much time. So thank you very much. And thank you for joining us. We delve into these matters and more in the report. So please keep an eye out for that. Otherwise, we'll see you next quarter.